In this video, I'll be analyzing a home furnishings retailer that has very little outstanding debt, has a strong record of returning cash to shareholders through dividends and share repurchases, and looks to be a little bit undervalued right now. This is episode 2 of my subscriber stock analysis series, and today we will be discussing the aforementioned company, which is Williams-Sonoma Inc., ticker symbol WSM. Let's start with some of the basics of WSM's business. As I mentioned, Williams-Sonoma is primarily a home furnishings retailer with most of their operations in the United States, Canada, Australia, and the United Kingdom. They have many retail stores, but currently their e-commerce business actually represents about 2/3 of their revenue and profits, which is pretty significant. They have a wide variety of brands in different niches, including the legacy Williams-Sonoma brand, West Elm, Pottery Barn, Rejuvenation, Mark and Graham, and Outward. For example, Pottery Barn is the largest brand, representing about 41% of revenues, and this brand focuses on furnishings such as furniture, bedding, lighting, and rugs, while the Williams-Sonoma brand represents about 15% of revenues and is more focused on the cooking, dining, and entertaining experiences. 2022 was a tough year for many companies, and 2023 has turned out to be a bit of a tough year as well. So let's see exactly how Williams-Sonoma has performed in recent months. First of all, looking at the full fiscal year of 2022, this year ran from the beginning of February of 2022 until the end of January 2023. And for the year, Williams-Sonoma reported revenues of $8.7 billion, which was a 6.5% comparable increase versus fiscal year 2021. A notable item on the income statement here, I think, is SG&A expenses. So year over year, they were about flat, but as a percentage of revenues, they were 25.1% in 2022 versus 26.4% in 2021, which is good to see. And management has cited a greater shift to e-commerce has actually helped to lower these SG&A expenses, which is great for the business. Operating margin for the year of 2022 was 17.3%, which is well above their target rate of 15% and above. And earnings per share for the year were $16.32, which was a record, and that was an 11% increase year over year from 2021. And return on invested capital for the year was 49.4%. More recently, WSM reported their first quarter 2023 results, and that quarter ran from the beginning of February to the end of April of 2023. And for the quarter, revenues were $1.8 billion, which was down about 6% on a comparable sales basis. As we can see as well, the gross margin was down substantially to 38.5%, and that was largely due to higher shipping and freight costs, management cited. Operating margin for the quarter was pretty low at 11.4%, which is way below the 15% target. But WSM is expecting a bit of a rebound in the second half of the year, which would put them closer to the 15% mark. As we'll see, their guidance says that they're expecting operating margin between 14 and 15%. On the earnings call, actually, there were quite a few questions about whether that guidance is realistic and attainable, and it sounded like the analysts were really unsure and skeptical if WSM would really be able to reach that 14 to 15% range for operating margin this year. But the management actually sounded pretty confident that they would reach that at least 14% for the full year of 2023. And earnings per share for the quarter was $2.35, which was down substantially from the last year. And for the full fiscal year of 2023, in terms of revenue, they are expecting somewhere between -3% and +3% year over year. And like I mentioned, they are projecting operating margin between 14 and 15%, but their long-term target for operating margin is above 15%. Another thing they did highlight on the earnings call is that they are definitely noticing a slowdown in the purchase of luxury and more expensive furniture, but customers are still investing in their homes and upgrading their homes in terms of appliances and electronic gadgets and just smaller ways to add value to the home as opposed to those bigger purchases. So the company is definitely experiencing some slowdowns due to the larger macroeconomic conditions, but I think generally speaking, they're in a strong position moving forward, which we'll talk about a little bit more as we look at the balance sheet next. So as we can see, Williams-Sonoma currently has about $300 million of cash on hand and a total of $1.9 billion of current assets. And comparing these current assets to current liabilities, we can see the current liabilities are at $1.7 billion, which gives them a current ratio a little bit above 1, which is great to see and means that they are in a strong position in the short term. We can also take a look at debt. So actually for WSM, they list their debt as operating lease liabilities. So they have about $230 million of short-term debt and then about $1.2 billion of long-term debt for a total debt of $1.42 billion. And this is a very sustainable debt level. Their current net income right now is in the range of $1 billion, $1.1 billion per year, which means they could pay off all their debt in much less than 2 years, which is generally the threshold that I like to see. So in my opinion, the balance sheet is very strong and tells us that Williams-Sonoma is quite prepared for an economic downturn of even greater magnitude than we're experiencing right now. And now taking a look at some of those sweet dividends that we like to see as shareholders, Williams-Sonoma right now has a pretty healthy starting yield of 3% with a fantastically low payout ratio of 20%, and they have been increasing the dividend for a strong 16 consecutive years and have a pretty awesome growth rate right now of 15% on average over the past 5 years, and I think over the past 10 years, their average growth rate for the dividend is around 12%. If I had to guess, I would predict that they likely won't grow the dividend at quite as quick a rate in the next few years just because of the slowdown in the business, but they still have plenty of room to grow the dividend at a modest rate in the range of 5 to 10% annually without any issues. Another way that Williams-Sonoma returns value to shareholders is through share repurchases, which they have done a lot of in the past 10 or 15 years. So they reduced the shares outstanding by about 40% in the last 13 years. And in the first quarter of 2023 alone, they retired shares that were worth about $300 million, which accounts for about 4% of the company's market cap, which is a pretty large chunk for one quarter alone. So far, it seems that Williams-Sonoma is a pretty solid business, but if we want to invest in the stock, we don't want to pay significantly more than the company is worth. So that's where valuation comes into play. And the first valuation metric I like to take a look at is the price to earnings ratio. And for Williams-Sonoma, their PE ratio right now is about 8. And as we can see from this chart, historically, their PE has averaged in the range of 14. So they are significantly below that at this point in time, which is a good sign from a valuation perspective. And I also like to compare a company's PE ratio to their peers in similar industries and sectors. So when it comes to their sector, Williams-Sonoma is in the consumer cyclical sector, and right now that sector has an average PE of about 15.3, and within that sector, Williams-Sonoma is in the retail industry, which has an average PE of about 14.7. So in all three of these cases, Williams-Sonoma's PE is significantly lower than it has been historically for them, and it's lower than their other peers are. So I think that points to an attractive valuation for Williams-Sonoma right now. Another valuation strategy that I like to use is a discounted cash flow model, and for this model, I used a required rate of return of 10% and calculated a fair value of $158 per share. And when we apply a 10% margin of safety, this gives us a buy price around $142 per share. And the current price of Williams-Sonoma stock is $120 per share, which means that this valuation method, the DCF, is showing that Williams-Sonoma is also undervalued, which kind of aligns with what we saw from the PE ratio as well. So Williams-Sonoma has had a great last couple of years. They have pretty strong brands, a strong balance sheet, and fantastic dividend growth and an attractive valuation. But should you be buying Williams-Sonoma stock right now? That's certainly a personal question that I definitely can't answer for you. But I will say this, it seems to me that a lot of Williams-Sonoma's success in the last few years has been due to kind of the COVID housing boom that we've seen. So it's important to realize that these trends aren't likely to continue, at least in the way that they've been going and the amount of growth that they've been giving to Williams-Sonoma. And some of that is likely to slow down. But those assumptions of slower growth are included in the DCF model that I calculated, so I don't think it's really anything to worry about all that much. And despite the economic uncertainty, I do think Williams-Sonoma is positioned to thrive because of their strong brands and strong balance sheet, as some of their smaller and less stable competitors start to struggle because of things like higher interest rates. Williams-Sonoma really has the strength and financial stability to take away market share from those smaller competitors and really grow their brand and business even more. I personally don't own any Williams-Sonoma right now, and I really really don't own any retailers in my dividend portfolio at all. So it's definitely a company I think I'll be keeping an eye on. I would be interested to hear if you do have any Williams-Sonoma stock, or if you have any additional thoughts or insights to share about the company and its future. Thanks for watching to the end of the video. Make sure to subscribe to the channel so you don't miss out on future videos, and I'll see you all in the next one.